the Australian dollar is pricing in a collapse that nobody's talking about yet. While the weekly chart is screaming strong buy, the 1 hour, 5 hour, and daily charts are all locked in strong sell mode. Price right now sits at 0.7110, just 20 pips above the 50-day moving average at 0.7090. If that level breaks, it is a trapdoor opening towards 0.7060, then potentially all the way down to the 100-day moving average at 0.7012. But if it holds, we could see a violent short squeeze ripping back to 0.7200. Today there is one danger zone and one hidden opportunity. I will show you both. Stay until the end because I am giving out 3 exact entry and exit levels you can use right now, complete with stops and risk-reward ratios, session bias right now, fading the bounce toward resistance, but only if 0.7090 holds as support. I am watching for a potential mean reversion short when we retest the MA20 area around 0.7188. But there is one invalidation level that will flip everything. If we get a 1 hour close above 0.7224, that resets the daily downtrend entirely and shifts the bias to bullish continuation. Write this number down, 0.7090. If we break below it on a daily close, the whole weekly structure is challenged. That level is the pivot. The first target on a breakdown is 0.7062, then 0.7012. That is your line in the sand. Right now, the market is repricing after that Westpac consumer sentiment data, and behind the scenes it is pricing in a slowdown in China. Let's get straight into the charts because this is where the conviction sits. I want you to zoom out with me to the weekly time frame. The trend structure up there is strong buy. The moving averages are stacked bullishly with the 200-week way down, but right now that macro uptrend is irrelevant for the next 24 to 48 hours because the daily chart has flipped hard. On the daily, we have a strong sell signal. Price is trading below the 5-day moving average at 0.7180, below the 10-day at 0.7208, and below the 20-day at 0.7188. Notice something crucial. The 5-day and 20-day are nearly converged right around 0.7180 to 0.7188, creating a thick resistance zone. If price rallies into that, it is a wall of selling pressure. The 50-day moving average, however, is sitting at 0.7092, and that is exactly where the current support battle is happening. This 50-day has been the dynamic support that has kept the weekly uptrend intact. Now price is hugging it, poking at it, and the tension is extreme. Below that, the 100-day average sits at 0.7012, and the 200-day is far down at 0.6787, the big macro line. The MACD on the daily chart is reading 0.002, essentially flatlined. That tells you momentum is completely dead. There is no conviction from buyers, no panic from sellers yet, but the bearish price action suggests sellers have the slight edge. RSI sits at 43, not oversold, meaning there is plenty of room to the downside before we hit any mean reversion triggers. The path of least resistance is lower unless we see a catalyst. Here's what most traders miss. They look at that 0.7090 level and think it is just another number. It is not. It is the 50-day moving average aligning perfectly with a previous swing low. This is structural support. On the 4-hour and 1-hour charts, the strong sell trend is clear, lower highs, lower lows, and the 4HMA20 is sloping down around 0.7145, give or take a few pips. Any intraday bounce that gets near that 0.7140 to 0.7160 zone is a sell opportunity. The key support numbers today are 0.7090, then 0.7062. Key resistances are 0.7196, the most recent breakdown point, and 0.7224, which is the swing high that must be recaptured for bulls to regain any credibility. The correlation engine is also screaming bearish. Australian dollar to US dollar is the China proxy. Iron ore futures have been sliding, copper is testing a critical support of its own, and Chinese equity markets are wobbly. That commodities undercurrent is the hidden hand pushing the Aussie lower. On top of that, The US dollar index has found a bid on haven flows, and S&P 500 futures are struggling at resistance. When risk wobbles, the Aussie gets crushed. So the cross-asset linkage is perfectly aligned for a breakdown, unless risk sentiment does a complete U-turn. Let's connect this to the fundamental driver of the last 24 hours. The headline reads, Australia consumer sentiment improved in May but pessimism persists, according to Westpac. That is a glass-half-empty report. Yes. Sentiment tick higher, but it remains deeply pessimistic, and that feeds into the narrative that the Reserve Bank of Australia might be forced to cut rates later this year if the economy loses steam. The market is already pricing a reasonable probability of a rate cut within the next 6 months, and that rate differential against the US dollar, where the Fed is still on hold, is a drag on the Aussie. Meanwhile, there is no major RBA speaker today to push back, so the market is left adrift with the broader risk-off flow. Over the next 1 to 2 weeks, my directional lean is bearish on Australian dollar to US dollar. I want to sell rallies until we see a daily close above 0.7224. The event that would invalidate this bearish thesis would be a surprise China stimulus announcement or a sharp breakdown in the US dollar index below the 104 handle. But until that happens, the sell-side pressure remains in control. Most people will skip this next part, but this is where money is made. Keep watching. I am going to give you 3 trade setups now, from conservative to aggressive, each with exact price triggers, stop losses, and targets. Strategy 1, the sniper. This is the conservative approach. You wait for confirmation. The trigger is a 1-hour candle close below 0.7090, followed by a retest of that broken level as new resistance. So the sequence is, price breaks 0.7090, then pulls back to the 0.7095 to 0.7100 area, and gets rejected. That is your entry, near 0.7095. Stop loss goes above the most recent swing high that formed during the pullback, which typically would be around 0.7130, just above the 4-hour MA20 resistance. That gives you a 35 pip stop. Target 1 is 0.7062, the next support, which gives you a 33 pip gain, roughly a 1-to-1 risk reward. Target 2 is the 100-day moving average at 0.7012, 83 pips away, giving you a 1 to 2.4 reward. This setup is voided if price recovers back above 0.7130 and holds there, indicating the breakdown was a trap. Strategy 2, the active trader. This is the standard play for those who want to capture the mean reversion within the strong sell trend. Here you sell a rally into the 4-hour MA20 resistance zone. That moving average is sloping down and currently sits near 0.7145. I set my entry zone between 0.7140 and 0.7160. Place your stop loss above 0.7190, just below that key resistance at 0.7196, so roughly a 30 to 50 pip stop depending on your exact entry. Target 1 is 0.7110. A quick 30 to 40 pip scalp to lock in initial profits. Once target 1 is hit, immediately move your stop to break even. Target 2 is 0.7090 first, then 0.7062. The trailing rule is vital here. After price reaches target 1, as it grinds toward 0.7090, trail your stop to 0.7105 once price prints below 0.7095. That way you protect the gain and let the trade run into a potential collapse scenario. This strategy exploits the fact that selling pressure reasserts itself at moving average resistance in a strongly trending market. Let's see how aligned we are. Type your Australian dollar to US dollar range for the next 24 hours in the comments now. I am reading them. I want to know where you see the high and low. Strategy 3, the aggressor. This is the high risk, high reward momentum chase. If you believe the intraday strong sell trend continues without a pullback, you short at market, right here at 0.7110. Your stop loss must be tight. Place it above the recent 1-hour swing high, around 0.7135. That is a 25 pip stop. Target 1 is the immediate support at 0.7090, a quick 20 pip gain. Target 2 is 0.7062. This is a sniper-like entry on the 5-minute or 15-minute breakdown. Only for those who know how to lose small and manage risk aggressively. If price spikes above 0.7135, you are out, no questions asked. The setup is invalidated the moment that level breaks on a 15-minute close. This play is about capturing the final acceleration of the bearish momentum into the key support. Never risk more than 1 to 2% per trade. No positions through high-impact US news releases. Stops are non-negotiable. The one critical level for the next session is 0.7090. A daily close below that opens the trapdoor, and we target 0.7062 and 0.7012. If buyers defend it and we see a vicious bounce, the level to beat is 0.7224. Tomorrow we are watching the US PMI data, which could be the catalyst for the next leg. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Check the end screen. Smash like if this analysis gave you a clear plan, subscribe and hit the bell for daily coverage. I will see you in the next one.